I have with me Tushar Poddar, the Chief Economist and Managing Director from Goldman Sachs. Good afternoon, Tushar. Thank you very much for joining us. I just have a report that you have released on India. And let me start with growth because that is the most elusive factor. Your forecast I see is 6.3% for calendar 2015, if I am not mistaken. The average for calendar 2014 as of now is just 5.2. So when is the inflection point? When do you get that big growth? Are you going to see it in the fourth quarter, the current one underway, or do you see it in next first of calendar quarter of 2015? And what is the breakup of the 4 quarters of 2015?
So, hi Latha, I don't think that this quarter you're going to see a significant pickup in growth. What we are seeing in terms of growth is more a gradual improvement. And we're seeing first the signs of improvement are in sentiment and in terms of financial conditions. So it's getting easier to borrow, it's getting easier, the spreads are coming down across the space. And that is a leading indicator of a pickup in growth. Finally, we are seeing the debottlenecking of projects. We are seeing coal supply increase 16% in October. We are seeing the cost of imported inputs come down, both in terms of oil as well as thermal coal. All of these are suggesting that a gradual investment cycle is underway. In terms of the distribution of growth, this quarter is still going to be weak. We are expecting a little bit of a pickup in Q1 of 2015, but it's really in the second half of 2015 that we're expecting a significant pickup in growth, largely coming from the infrastructure sectors. Power demand will probably grow in double digits. Coal, clearly we're seeing some debottlenecking which is helping the power sector. We're seeing the bidding out of road projects going on. So it's going to be more public sector-led growth rather than private sector-led growth. And the composition is going to be geared towards an improvement in investment demand rather than consumption demand at this stage.
Okay. And when do you see that investment demand in which quarter perk up? Because the last number we have, that is third quarter calendar 2014 or second quarter fiscal 2015 is unchanged. I mean, it is a 0% gross fixed capital formation growth. When is the inflection point?
So, Latha, I would sort of de-emphasize the quarterly data from the expenditure side.
Okay.
That is notoriously difficult to read, and in many cases it's outright wrong. I think what you're seeing, you're not going to see a sharp break or a V-shaped recovery. What you're seeing is a gradual sort of pickup, which is led initially by sentiment and by the public sector. And you will see on the industry side growth rates of about 2–2.5%, which you've seen already if you average across the last 5–6 months. That pickup to more in the 3–4% range towards March and then towards the second quarter of 2015. And then picking up to the 4–5% range as we go into the second half of 2015. So you are not going to have a eureka movement when you feel that it's a sharp pickup, simply because it's a gradual pickup. And I think that these sorts of pickups are more sustainable rather than a policy-induced V-shaped recoveries.
Okay. Well, the more eagerly sought answer is to the question, how will inflation trend and when are you expecting the first rate cut from the Reserve Bank?
So we've had the view that the first rate cut is going to be in February before the policy meeting, and I think that the governor's statement on December 2nd is, to us it seems like we're on course for a February rate cut. The inflation numbers in November and December are still going to be on the softer side, largely because of the commodity shock. Unless we get a negative food shock in the next few weeks, I can't see the data for the that comes out for November and December being anything but soft on inflation, and therefore the RBI will have the room to cut as it meets on February 3rd for its policy meeting. And then beyond that, there is a gradual pickup in inflation because some of this is due to base effects. But we are looking at inflation reaching more the 5.5% range rather than the 7% range that was there before this massive positive commodity shock that India has witnessed.
When is that 5.5 number? Is that the March 2015 number? And what is the expectation by Jan 2016?
So let me answer your second question first. On Jan 2016, the expectation is that it's going to be fairly close to 6% in our forecasts. Of course, the uncertainties around that are large, given that we've been, we are 12 months out, and there are such large shocks affecting the Indian economy, along with base effects. But and as we sort of go through the year, there are two trends visible. One is that the second round effects of the positive commodity shock will be witnessed in the first half of 2015. So that's going to act as a dampener to inflation. But on the second half of 2015, we're expecting a slight pickup, partly because the output gap, which is the difference between potential output and real activity, closes as real activity starts picking up. So that can impart a little bit of inflationary pressures on core. And second, we don't expect the kind of commodity price decline that we have seen in the last 3 months going forward. So, oil at 70 we're not seeing it going down to 50, for instance. Our forecast for 2015 is at $84 a barrel on average. That is still going to be significantly lower than the 2014 number, but incrementally you may not see a sustained fall in commodity prices, which can pull inflation down. So the trajectory of inflation as you go into 2015 is much softer initially and through the first 2 quarters, and then a gradual pickup in the second 2 quarters of 2015.
So how many rate cuts, if your Jan 2016 number itself is 6%, and the governor has spoken of at least a 1.5% positive real rate of return, not too many rate cuts in 2015?
Correct. We have about 50 basis points priced in. So 25 bips in February and 25 bips in April is what our view is. As I said, as you go into the second half, not only is the inflationary pressures picking up, but the fact that the yield differentials between India and the US start shrinking as the Fed starts hiking rate starts becoming an issue. So I don't think that there is a lot of room for very aggressive rate cuts by the RBI. The only way that this situation can change is if the inflation numbers surprise meaningfully to the downside, which means that we get inflation prints of 4% or a 4 handle sustained over a period of time. That can give some room for the RBI. But if you believe that inflation is going to be in the 6% range, then I think that you're not going to see very aggressive rate cuts by the RBI.
Okay. We don't have the luxury in a news bulletin of a detailed argument, unfortunately, Tushar. But you have an interesting thesis about India's potential growth getting to only 7%, and even that in FY19. Not a very optimistic outlook, but still much better than the 5% we are lingering now.
Actually, it's quite optimistic because potential growth takes time to pick up. I'm talking about potential growth that is durable. You can see, ups and downs in actual growth, but for potential growth to pick up, you need supply-side factors to come together. And the number of supply-side factors that are coming together for India at this stage is pretty impressive. On the one hand, you've got technology and the whole internet revolution that's happening. We are projecting that the number of internet users goes from about 200 million currently to more than 400 million in 4 years' time, and then to 600 million in 8 years' time. That itself adds about 30 basis points to potential growth, just the technology sort of change. Then improvements in structural reforms which help the micro environment, the cost of doing business being reduced, the atmosphere becoming much more conducive to investments. That itself also adds to potential growth, and on top of that, capital accumulation. So 6 to 7% in the context of a global economy which is still not sort of firing on all cylinders is not a small achievement. And if we do get to 7%, India's potential growth is going to be higher than China's. In fact, our view is for the first time in 2016, India will probably overtake China as the fastest growing large economy in the world. So that is the forecast, which is sort of underpinned by the potential growth improvement argument.
No, certainly that will be a big magnet for investments, global investments as well, if the delta and the direction are so strongly attractive. Tushar Poddar, would have loved to continue this conversation, especially to ask from you what will be the gains from India going down in the corruption index. That I think has been the big achievement over the year. But that for a later date. Pleasure speaking with you. Thank you so much for joining us.